Welcome to the course, What Affects the Price of Gold? This topic will be an important one in understanding some of the general prices of gold determinants, and this will mean that we'll be looking at dynamic drivers, real interest rates, and also momentum in the gold spot price. The first thing to consider is something that is observed in the gold market but isn't specific to the gold market, and that's that the key events that are driving the price of gold will change. There won't be just one event that the gold market is priced on. There could be something that happens in the world, and then gold becomes very sensitive to any developments in this new situation. But then over time, the market will start to look at other things, and it might go back to looking at some of the longer term aspects. So it starts to ignore that short term event that occurred. When we talk about long-term drivers of the gold spot price, the most important of them is the real interest rate. And we will be looking at this in detail in the course. But something to talk about at this stage is that bullion does not generate any cash flow. A bar of gold doesn't give you a return as such, like bonds or equities, because bonds pay interest payments and equities, which are shares, they often pay dividends as well. So there's actually cash flow. And this is so important in understanding why the interest rates impact the gold price, because the higher the interest rate payment on a bond, which is considered the risk-free rate of return, the higher that is, the higher the opportunity cost of holding gold bullion. And what I mean by this is that gold investors are losing out on holding gold instead of bonds when the return on bonds is high. So they're basically forfeiting. If you have a lot of money held in gold bullion, you're forfeiting the interest payments that you would get by investing in your own government bonds. So when the interest rates are low, there's not much of a forfeit there because you're not really risking much. But if, say, you would get a 10% payment on a bond and you're holding gold, then you could sell that gold and buy a bond and get 10% return. So the opportunity cost is quite high, and this is why gold is sensitive to interest rates on bonds. You can't really get far when it comes to looking at what determines the price of commodities without learning the difference between nominal interest rates and real interest rates. Nominal interest rates, that's the easy one because that is the actual rate that is paid. But the real interest rate is the nominal rate adjusted for inflation. So if we look at a scenario, if the nominal interest rate is 3% and the rate of inflation is 2%, then this means that the real interest rate is 1% because we have adjusted that for inflation. And so basically real interest rates show you what you get once inflation has affected the interest payment that you receive. And momentum is a key driver of the gold spot price. Empirical observation by Hardman and Co. They looked at gold exchange traded funds, and they found that in uptrends, investors in the West, they want to increase their exposure to gold when the price is rising. But when the price is falling, they want to get out of that exposure. So basically this is self-fulfilling. Gold price starts to go up and it attracts more buyers into the market, which then in turn pushes the gold price higher. And then when the gold price has a downwards momentum, people want to cut out of their positions, which causes selling, which weighs further down on the price. So this is where momentum is key. And this explains findings by Oxford Economics. And what they found is that shocks to the gold price wear off relatively slowly. So if you have a period of consolidation and then the gold price goes up, what they suggest is that that won't mean revert very quickly. It will continue to go up. So if you get a swing of the pendulum, there's a big rally or a big fall, you would expect that move to continue for some time. And when gold does normalize, so basically this means coming back to more of a historic average, this could happen in two ways. The obvious is that the gold price if it spikes up, it could come back down to an average, so it mean reverts. But they also suggest that this is not guaranteed. So if you have gold spike in price, gold doesn't have to necessarily retrace. What could happen is that general prices in the economy move upwards so that a new equilibrium is found with the gold price and consumer prices.